Chapter 14, all about accounting. I think this chapter has some great information in it. And I hope you find it beneficial as well. I always tell my students that, whether you're an accounting major or not, it's always good to have a good foundation of just the basics of accounting knowledge, if you will. Even if you're not going to be an accountant, it's great to utilize in your everyday personal lives. So I think you'll find it beneficial. And if you've taken accounting 1 or 2 or both, this information will probably be more of a refresher. And if you've never had any type of accounting class, a lot of it may be new to you, but hopefully you'll find it beneficial. I like giving this information because I have a lot of students that are accounting majors or want to be accounting majors. And so hopefully you can get some good insight from it. But financial information is central to every organization. So to operate effectively, businesses must have a way to track income, expenses, assets, and liabilities in an organized manner. So the beginning of the chapter talks about financial reports and accounting information and why they are important and who uses them. Okay, so accounting itself, it involves collecting, recording, classifying, summarizing, reporting, and analyzing a firm's financial activities according to a standard set of procedures. So the financial reports resulting from the accounting process give the managers, employees, investors, customers, suppliers, creditors, and government agencies a way to analyze a company's past, current, and future performance. So financial accounting is concerned with the preparation of financial reports using generally accepted accounting principles. And then managerial accounting provides financial information that management can use to make decisions about the firm's operations. So then the chapter goes in to talk about accountants, different types of accountants, and there's 2 main types. We've got private accountants, and public accountants. And public accountants work for independent firms that provide accounting services such as financial report preparation and auditing, tax return preparation, and management consulting, and typically to other organizations on a fee basis. So if you hear CPA or that terminology, that stands for Certified Public Accountant. And so that's what type of accountant they are. Private accountants, on the other hand, are employed to serve one organization and may prepare financial statements, tax returns, and management reports. To be a CPA, you have to sit for that exam, which can be pretty rigorous. So it takes some studying. But a lot of times people like to go and be CPA certified because it does give you that edge and some more employment opportunities as an accountant. So it talks about the bankruptcies of companies like Enron and WorldCom, and we'll dig into these a little bit more in chapter 16. And if you're unfamiliar with them, you should look into them. There's a great docu-series, if you will, on Enron, that I think you would find very beneficial. But anyways, there's bankruptcies of those large companies plus widespread abuses of accounting practices raised critical issues of auditor independence and integrity and reliability on financial reports. So to set better standards for accounting, auditing, and financial reporting, and to prevent future accounting irregularities, Congress passed the Sarbanes-Oxley Act in 2002. So this act establishes an independent board to oversee the accounting profession. It sets stricter auditing and financial disclosure standards and places increased accountability on a company's senior executives and management. So it really just helps to oversee accounting practices and give that extra layer there. Other organizations such as the SEC or the Securities and Exchange Commission. So when I say SEC, not to be confused with sports, if you're a sports person, you know what I'm talking about. The New York Stock Exchange and accounting industry professional associations issued new regulations and guidelines related to compliance with the Sarbanes-Oxley Act. All right. So your book talks about the accounting cycle, and there are 6 different steps in the accounting cycle. The first one, also let me backtrack real quick. The accounting cycle is used or refers to the process of just generating financial statements, all right? So the first step in that is analyzing business transactions. Then you're going to record them in journals, and then post them in ledgers, all right? Ledger totals are then summarized in a trial balance that confirms the accuracy of the figures. Then the accountant will prepare the financial statements and reports. And then the very last step involves analyzing these reports and making decisions based on these reports. So, and technology and computers really have simplified many of these labor-intensive tasks. Accounting used to be done all by hand, handwriting them in journals and ledgers. Now we have lovely computer systems that does it all for us. So QuickBooks being one of them. If anybody has taken, we offer a class at UAPTC. So if you've taken it, that's a huge one that a lot of companies, especially smaller businesses, use for their accounting purposes. But so then it talks about, what terms does the balance sheet describe financial condition of an organization? So when we talk about the balance sheet, which is one of our financial statements, if you will, the balance sheet represents the financial condition of a firm at one moment in time. So that given moment in time, in terms of assets, liabilities, and owner's equity. So the key categories of assets are current assets, fixed assets, and intangible assets. So liabilities are divided into current and long-term liabilities. So owner's equity, which refers to the amount the owner's investment into the firm after all the liabilities have been paid, is the third major category. So again, on a balance sheet, we have our assets, our liabilities, and our owner's equity. And to kind of sum it up a little bit quicker, our assets are what we own, our liabilities are what we owe, so think debts or anything like that, and owner's equity is what we have at the end of the day once everything has been paid. What do we actually have left? So your assets minus your liabilities equal your owner's equity. So we're going to think of it that way. And then it talks about the income statement, all right? And how does that report, the income statement report a firm's profitability, all right? And so the income statement is a summary of the firm's operations over a period of time. Usually, to make things simpler, it reports in time frames of a year or so at once. But the main parts of the income statement are revenues, so your gross sales and your gross and net sales, cost of goods sold, your operating expenses, so think selling, general expenses, administration expenses, and then we've got our taxes, our net profit, or our loss, hopefully profit. So that kind of is what the income statement entails. So again, it shows your revenues, all right? So what kind of sales you have, both your gross sales and your net sales, your cost of goods sold, your operating expenses, how much did it cost you to actually sell these goods, your taxes, and then what do you have at the end of the day? Did you make a profit? Did you lose money? That all is going to be on the income statement, all right? Then it goes in to talk about the statement of cash flows, all right? And the statement of cash flows summarizes the firm's sources and uses of cash during the financial reporting period. Again, typically when you're looking at them for a year at a time. But it breaks the firm's cash flows into those from operating, investment, and financing activities. And it shows the net change during the period in the firm's cash and marketable securities, all right? So the cash flows, in short, it's showing how the activities of cash coming in and out of the company. So then, toward the end of the chapter, it talks about ratio analysis and how this can help identify a firm's financial strengths and weaknesses. So Ratio analysis is a way to use these financial statements to gain insight into a firm's operations, profitability, and overall financial condition. So the four main types of ratios are your liquidity ratios, your profitability ratios, your activity ratios, and your debt ratios, all right? So comparing a firm's ratios over several years and comparing them to ratios to other firms in the same industry or to industry averages can really indicate trends and highlight financial strengths and weaknesses, all right? And so it's not necessarily necessary to memorize these ratios, but just being able to understand them. So if you need to utilize them at any given point, you have them. But I mean, you can always look them up and you can have them at your fingertips. But just the important part is not to memorize the ratios, but just kind of understand them, all right? And then the very end of the chapter talks about different trends affecting our accounting industry today, all right? And so the post Sarbanes-Oxley Act business environment, if you will, has really brought many changes to the accounting profession, including higher standards for audit procedures, which were obviously very well needed. So in the addition, this has really kind of made a slow but steady process in making changes. And the implementation of global accounting standards may not occur anytime soon. So several important trends will continue to impact the accounting industry going forward, including the cloud-based services, automation, staffing challenges, as accountants kind of shift the focus of their practice to one incorporating technological advances and more comprehensive approach to their company's clients and just overall business environment. So real quick, I'm going to give you to kind of piggyback on that, since we talked about the Sarbanes-Oxley Act and kind of how it came about. So again, if you're not familiar with the Enron scandal, it's kind of two-part because it involves Enron and it involves Arthur Andersen, which was Enron's accounting firm. And so Arthur Andersen was kind of fudging numbers for Enron. They were inflating their numbers to make it look like Enron was making more money than they were. And so by doing this, the stocks would go up because, the more money a company makes, Enron was a publicly traded company, the higher the stocks are generally. So people were buying these stocks, and then, and you'll have to look it up. If you do a quick Google, you'll find out about it, find out more about it. But there was a whistleblower that kind of blew it all and told the story, if you will. But so once it came out that the accounting firm, they were fudging the numbers and Enron was not making the money that they were saying they were, obviously their stocks crashed, and it ended up resulting in Enron and Arthur Andersen actually going under, and they are no longer in business. But that was I think, the huge part of why the Sarbanes-Oxley Act came about, was because of the Enron scandal. So I hope, if you are not familiar with it, that you go look it up, because I think you will find it very interesting. But anyways, that is a wrap on our kind of highlight review for Chapter 14. Hope you enjoy, and I will chat with y'all soon.